think really was just an extension of what's going on in the US. And if we have a look at what's happening in the US, it's actually been a fantastic performance for the US stock market. In fact, the S&P 500 over the past 1 year is up by 20%. So that beats the Australian market, which is up by around about half of that, up by around about 10%, and the FTSE, which is up by about 7%. I think the view out there is that the US stock market has gotten ahead of itself, and the valuations, the earnings just don't support the rise that we've seen in terms of the US stock market. So in particular, it is those high momentum, high growth stocks which are being sold off, and they're the technology as well as the biotech stocks. Luckily for Australia, we don't have a lot of technology or a huge portion of our market in biotech stocks. In fact, this has been called the mini tech wreck at the moment. If you have a look at the tech wreck which happened back in 2000, the US stock market saw some big losses. Japan saw big losses because both of these markets do tend to be quite tech heavy. But Australia was really spared the brunt of the falls because we don't have much of a tech sector here. I guess if we have a look at Australian tech stocks or high risk, high momentum stocks, they tend to be stocks like iProperty, which was down by 11% today, Xero, which was down by 9% today, REA Group, which was down by 5.2%. Also, some of our companies are dual listed and they also trade on the NASDAQ. And they're companies like Mesoblast, which actually saw a 3.6% fall on the NASDAQ on Friday. Today, on the domestic session, down by 9.4%. But all up, it was very much risk off. We saw the S&P ASIC 200, the benchmark index, down by 0.2%. But if you drill down into the mid-cap index, that was actually down by 0.5%. And the small-cap index was down by 0.8%. So it was all about getting into the defensives, like the consumer staples, like the utility sectors, which actually finished up in the black. But having said all that, very light volumes. We didn't even crack the $3 billion mark today. So last week was an absolute slow week, but if we keep on going the way we have today, it does look like we're in for the worst week in terms of volume since January, so holiday time. So we're looking at holiday volumes at the moment.
Why do you think that is? Is it because we've got a few, public holidays coming up, Anzac Day, Easter? We've got, I think, 3 or 4 coming up.
It looks like a lot of people are sitting on the sidelines at the moment while the market does experience this type of volatility. And I think we didn't see a huge change in terms of quarterly performance. So it does look like a lot of money managers may also be set in their strategies. I think another consideration is the very high Australian dollar at the moment. If we have a look at the high Australian dollar, it does tend to discourage international investors from getting involved in our market. And they probably make up around about 20% of the volumes on the Australian share market. So the Aussie dollar is going to be one thing very much in focus this week. We saw the ANZ job ad numbers coming in with a strong set of numbers for the second consecutive month. If we do see the official job numbers, which are out on Thursday, impressing on the upside, the market expecting 5,000 jobs, and we could see the Australian dollar actually cracking through that 93 US cent mark. So I think the strong Aussie dollar is probably one component. The fact that we have seen strategies pretty much set for the year and no change after earnings season, probably another reason that we are seeing light volumes. And of course, in the month of April, we also see the Easter long weekend as well as the Anzac Day holiday. And with those so close together this year, we're probably going to see a lot of participants in the market just taking that period between Easter to Anzac Day off.
Mike, high frequency trading very much in the headlines, particularly in the US, off the back of a book by Michael Lewis, has certainly been causing quite a few headlines. It seems ASIC once again domestically turning its focus to high frequency trading as well.
There's been some talk that ASIC's looking to revive plans to put a half-second pause on trades. And of course, for normal retail investors, this won't make any difference. So if you're looking to buy or sell shares, it's not going to have an impact. But where it would have an impact is high-frequency trading, which relies on speed. And often in these areas, we're talking about fibre optic cables or even microwaves these days. And we're trading in terms of microseconds, which is 1/1,000,000th of a second. So we're talking at very low latency levels, very high speeds. And these high speeds mean that sometimes these high frequency firms have an insight into what's happening into the market before the rest of the market does. So essentially front running the market. If we do see that half-second pause, I think we'll see a big impact in terms of the ASX. Now the ASX core market is the cash market, and it's estimated between about 30 to 50% of volumes per day are due to high frequency trading, low latency type of strategies. So if we see that those type of volumes disappearing from the market, that would have a massive impact in terms of the ASX revenues. We already know that its derivatives business is under a lot of pressure, and if we'd see that core cash business coming under pressure as well, we could see the ASX share price continue to come under pressure. In the past month, we've actually seen the ASX shares down by 4.2%, and that's compared to the market, which has managed to lose 1%. So the ASX has been underperforming, and just watching those ASIC regulations and the impact that it would have in terms of volumes. Of course, it would have an even bigger impact in terms of Chi-X's volumes, but of course Chi-X isn't listed on the Australian share market, so I guess we'll be concentrating on those ASX shares.
Mike,